Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Phil, welcome to episode 3 of this insurance series. How you going, mate?
Good. How are you?
I'm good, mate. I'm good.
I realised the last time I didn't even ask you how you were.
Yeah, well, I'm good. But you probably didn't want to ask me that because in the first episode, for anyone that's watching, I did almost cough up a lung in this insurance episode. So in the first one, I have my drink bottle here, my trusty Frank Green. I get whatever was trendy last year in drink bottles. That's what I get this year. And I was trying to just keep that, but now I've got my honey lemon for my throat. So I'm all smooth sailing. So you can ask me how I'm going. But anyway, we're talking about insurance. This episode, we're talking about income protection. In the previous episode, we talked about lump sum insurances, things like life, disability, life, TPD, trauma, and child's cover. In the first one, we talked about the essentials and how this type of insurance is different to things like health insurance and car insurance, and the list goes on and on and on. In the next episode, we're going to talk about how you can pay for your insurances and the different options that you have, because it's not just like something you have to pay like a Netflix subscription. You do have choices in how you pay for things. But in this episode, this is probably going to be the most popular one because we're going to talk about income protection. And all my tradie mates, fortunately, at least all of them that I know, have this and they take this one seriously for multiple reasons. Now, I think what we should start with is that you're a financial advisor who specializes in insurance, and your team does as well. You've got a whole team around you of really talented financial advisors that just do this one thing really well. And we talked about in the previous episodes how it can make sense, and it does, in many instances, I will say, make sense to pay an advisor to do this part of your financial life, even if you're one of those independence warriors who, is on a ramen diet. That's fine. But this part of your finances does, I think, need expertise. Most people will struggle to think about this before it happens, Phil. But I just had some really bad news and heard some really bad news with some friends and what have you, like health-wise. And I could only think about how difficult that must be. But then I've got the other side of my brain, which is my finance brain, that's also like, holy shit, did they have insurance? Like, this is going to be so stressful. But then they've also got a household that they have to run. They've probably got a big mortgage. Like, I'm just like, how does this all compute in my head? And it's not even me going through it. How does a financial advisor help in those types of situations?
So in terms of at the claims experience,
yes.
Yeah, I mean, that's really where the rubber hits the road, like making sure that the insurance company pays the claim. Now, insurance companies, they will pay the claim based on the product disclosure statement. If it's eligible to pay a claim, they'll pay it out. If it's not eligible to pay a claim, they won't pay it out. Now, that said, does come in some commercial realities, and we don't ever push our insurers to pay illegitimate claims. I'll never say, hey, you should pay this, even though it's not an eligible claim. But actually, I just had an experience like last month where a client wasn't eligible for a certain thing. Her waiting period was meant to start 2 months later instead of back when she first became sick and injured and ill. And I pushed on that insurer and said, we're talking about literally 1 half day difference in terms of what the contract says and what the client's experience was. I think it's reasonable to, based on, on the spirit of the contract, to do it under that. And so the claims assessor said no. The claims manager, the head of claims for this insurance company, said no. And so I picked up the phone and I called the head of sales, and I know the CEO, and I was like, I'll go to the CEO because this should be paid based on the spirit of the contract, even though contractually we can all agree that it wasn't eligible to pay it. And also, I believe it was in the best interest for the insurance company because this experience was chronic fatigue. The longer she's off claim, the worse the experience will be long term, and the worse it'll be for the insurer. So I was trying to come with a lens of it's best for the insurer, best for the client, and can we just all come to a reasonable outcome? But when you look at the T's and C's exactly, it wasn't eligible for it. And anyway, we were able to get that done. So that's not like every experience through an advisor, but that's just definitely the expertise that an advisor can bring to it is it's not just about the T's and C's, like have a relationship with the claims manager and help them understand there's a human being on the other end, because they're doing this day in, day out, and it's a rough job being a claims assessor. But when it comes to claims, it is really valuable having an advisor advocate for you and just take a lot of that load off. Like, it's pretty daunting asking a big, significant institution, can I get paid this month? And there's stories after story about that type of experience where we've had to, get involved and really advocate for our clients and gotten really successful outcomes.
I can imagine the last thing you want to do in that situation, not necessarily the chronic fatigue one, but maybe in the chronic fatigue one, but just in general, the last thing you want to do when you're ill or a family member's ill is to be on the phone to an insurer. No offense, mate, but it's probably one of the least interesting things that people have to do in their lives when it comes to their financial lives. They don't want to sit there and try and go through the hoops and whatever. To be able to use a resource at that particular time is so important. And I think like a good litmus test is like, when was the last time anyone watching this or listening to this spoke to their insurer, like actually just called them up, and how was that part of your day? And do you look forward to doing that again, or would you ever think about wanting to do that when things aren't going right in your life? So I think that's a really important thing. And we're using the analogy of a mortgage broker in the last episode, but like, when it's typically that they do their best work when you're least comfortable with the thing that you're trying to get done. And that's definitely been the case with me. It's like when you're not a cookie cutter, you don't fit in this mold, something's happened. That's really important. Now, in this episode, we're talking about income protection. We did define it, and we have talked about it a little bit in the first few episodes. But for folks that are just tuning in now, let's start with a simple and obvious question, which is, what is it?
Income protection is an insurance policy that protects your income. At its simplest. So how it's paid out, how it works is, if you're unable to work because of an illness, injury, or sickness for a period of time, then the insurance company will replace a percentage of your income. So it's not a full replacement of your income. You don't just get the same paycheck. They'll often replace 70% of your income. And that income protection payment also does get taxed. So I guess, quick action point. I know we're going to get it to the end, but check about what the after-tax income payment will be. But we'll circle back at the end when you ask me that question. Okay. So it's a monthly payment. You'll get paid every single month you're off work. As soon as you return to work, then the income protection policy stops.
So, quick question. Wasn't one that I was going to ask you, but I'm just thinking of it now. People get confused between what we're talking about, income protection, and work cover. Different things?
Yeah. They are different things. So, and this is why tradies often like income protection, because they know that they're self-employed, they're not going to get work cover. But work cover is not a replacement for income protection. So work cover, what it does cover you is if you're injured at work and it's proven that it was a workplace related injury, then you'll get paid out for a certain period of time. Income protection is, I could be going to Hobart and go on the back of a boat, fall off the boat, injure myself, and I'll still get paid out. I don't need to be at work. I don't know why I thought about Hobart. Me and my wife are going to Hobart in September, so I was thinking about.
Hopefully, you don't fall off the boat if you're going on a boat. Stay
away.
I'm
going on a boat, not in Hobart. It's too cold. So income protection will pay you out worldwide. So if you're going traveling, if you're injured on the weekend, even if you're doing something stupid that you shouldn't have done, the insurance company doesn't have like a requirement of no idiots allowed. You can do idiotic things and still get paid your income protection payment.
Okay. Well, that's good to know. So then I fit the bill.
Yeah.
But the biggest, other than tradies hurting themselves, self-employed tradies hurting themselves at work, that's probably the number one thing. But the second thing where I see income protection in my life kick in a lot of the time is with people playing sport. I'm like, at that age where people are my age and they're still attempting to play weekend sport and managing to hurt themselves significantly, like broken legs and God knows what. But I've noticed those people. Those are probably the most prominent figures in my life that keep popping up as relying on some form of income for a while. Um, okay, so you mentioned 70%. That is interesting. So even if I earn round figures, 10 grand a month, the maximum my policy could be would be 7 grand a month before tax. Is that correct?
Correct. Yeah.
Go for it.
It's a little nuanced, like as in older policies had different replacement ratios, super policy had different replacement ratios. So it is a little nuanced. But if you just go out there today, want to get a new policy, just think round figures, 70%. You can add some money for super contributions as well.
Okay. Now, let's say, for example, that I'm earning 10 grand a month and then I get 70%. But in 18 months, I'm earning less. I'm earning 7 grand a month for whatever. I've changed occupations. I don't want to be in finance anymore and I want to go and do something more free spirited.
I thought you were going to say more fun.
More fun. Well,
yeah.
that too. And now I'm earning less, but I've still got my same cover. So I'm like, that's interesting. What would happen if I went for that amount of money, the original money that I'd, set it up with?
So the lump sum covers that we talked about in the last episode, they are whatever you're covered for, you get paid out on. Income protection works very different, and it's very important to make sure you're in communication with the advisor that you're setting up with, or at least you understand how the policies work, because at the time of setting up the policy, the insurance company will give you a maximum of 70% replacement ratio. So if you're earning 10 grand, you can't even request $10,000 per month cover, even if you know you're not going to get paid out, because the insurance company won't offer you the cover and charge you the premiums if they're not able to pay you that money. But what happens when your income drops, at the time of claim, the insurance provider will look at what is your pre-disability earnings. And so your pre-disability earnings on today's contracts is the last 12 months. Now, there is some wiggle room if there is parental leave. So if you have been on parental leave, there is some grace period depending on whether your income protection is through your super fund or through an advisor. It's definitely worthwhile knowing that if you are going on parental leave. But generally speaking, it's just whatever your last 12 months of income is. Now, if you've got an old policy, which I know a lot of people in the Rask community may have set up policies 10 years ago, those older policies can sometimes be based on what is your best 12 months of income over the last 3 years. And even better policies are just straight agreed value. So the insurance company have got an agreed value policy and they've charged you more for it. But even if you're not earning that 10 grand, they'll pay out that 10 grand. But you can't get that today. That's not allowed.
Why is it not allowed? Is that just like an industry change?
APRA. Oh, here we go. Let's geek out. I love it.
Okay.
APRA is the insurance regulator. They came in and they were concerned about sustainability of life insurance companies. And so based on the fact that they were losing like $3.2 billion over a 5-year period, they said you can't lose money. And the reason they were losing money is because they were all just competing because it was a competitive market. They wanted to compete, so they kept their prices too low and unsustainable practices. So APRA, as a regulator, they don't want any insurance company to fall over. They said, if you offer these old insurance products, we're going to increase your capital charge. So again, double click on that. So insurance companies, they have to set aside a bucket of money to guarantee those claims that they're promising. And so the regulator said that bucket of money actually needs to double if you want to keep offering those products. But what you can do is keep that bucket of money as is if you reduce the benefits and the features of those new products. So you can hold the old products that are good, but the new products are not as good. So that's why the income protection is very nuanced, because there were changes back in 2021. And this is, again, not to speak to my own book, but like go and speak to an advisor, because income protection is complex and you may need to increase, decrease, every few years depending on your income movements.
Okay. That's interesting, because I do remember seeing agreed values in income protection policies. So the key point is, if you're setting up one of these things today, is that it covers a certain amount below your actual income. Is that a starting point for people when they assess how much they need? How do you consider how much someone actually needs?
So, two areas. If you're self-employed, much more difficult, much harder, and we actually charge a little bit higher. Our initial fees a little bit more. But if you're employed, it's generally what's your salary and what's your super. Now, if you get paid bonuses, commission, or anything like that, and it's consistent over a few years, then you can maybe include that. But again, it's thinking about at application stage, how much will an insurance company give me in terms of level of cover, and at claim stage, what will they pay out based on? And sometimes they can be different. So at application stage, they can be more strict, even if they would allow it at claim stage.
So a lot of the people in the Rask community are good little workers. We're all kind of out there trying to just make a bit more money and save a bit more and invest a bit more. Let's take a hypothetical and say, hey, I was earning $10,000 and next year I'm going up to $12,000 a month, right? Woohoo. Can I increase the cover over time, typically?
Yes, you can. You've got to go through an application process generally to increase it.
Right.
And so it's a full new application, full medical disclosures again, everything all again. There are some nuances with cover when you set it up through an advisor where they offer what's called a guaranteed future increase. So if A, B, and C happens in your life, you can increase your cover by X, Y, and Z. So for income protection, a good example is if I get a pay rise and my income goes up by more than 15%, then I can go back to the insurer and increase my level of cover by 15% based on that promotion, essentially. But again, and again, coming back to our point from, I think, the last episode, when we're talking about like ongoing commissions for advisors and is that value for money, income protection is where you need to be closely in touch with your advisor if they've set up the policy, because it is very nuanced in terms of what you can be paid out on. Because sometimes, we talk to our clients, hey, even though you won't get paid out this level of cover, based on your future plans and what you want to achieve with your life, you're going to go back to work full time. So we don't want to actually go through the application process again. So it is very nuanced, and that's why it's really important to either work with an advisor or understand the policies really well. So when you need to update it and increase through your super fund, you're able to do that.
In the last episode, I asked you about if people could have multiple insurances, like as in 2 lots of life or death/death insurance, like if they could have 2 policies that would both pay out if someone died. Can you have 2 income protection policies?
Yeah, the answer is yes. It's as long as the total amount that you're paid out on is no more than that 70% cap.
Bugger. So I thought I found a loophole in the system.
Yeah. So we do that a lot with our clients, actually. Like with the super fund, you can often get default cover, but with any new policy, we're going to likely get an exclusion on that new policy. So we often like to keep that existing cover because it doesn't have exclusions and loadings on it. And so often we can either have 2 or even sometimes 3 income protection policies to kind of fill in the gaps.
Yeah, that makes sense. So you get the best product of the time, but knowing that if you move to a new one, the last 3 years, old mate's got a little bit older and has got some new medical issues that they're not going to be covered for. So keep the existing one, but get some new one for this other thing.
Exactly.
Yeah, cool. That makes sense. All right, I got 2 more questions for you. One is, if I'm a business owner, which I am, let me rephrase that. We've got about 11,000 business owners that listen just to our business podcast alone, right? So a lot of people run their own business, and a lot of those would be small business owners, yeah. That works. Can people that run a business get income protection?
I feel like a broken record. It's nuanced. So there's kind of 2 different business owners. One business owner, self-employed, doesn't have any staff. Now, if you're or small number of staff members who can't perform and run the business without you. So if you're key person dependent on you being in the business. So in your situation, that's very true. If you're not here, how long is Rask going to be around for? Probably not that long. And so you can get income protection for that. There are things when we set up the policy, again, it's this difference between at application stage, how much will an insurer give you, and at claim stage, it may be two different things. But at application stage, we can do what's called add backs. So again, if you've gone through the mortgage broking process, like depreciation can be added back into your income when it comes to income protection. There are other add backs as well that can be added back to say, even though your taxable income is $100,000, 20 of that is depreciation. And so we can assess your income at $120,000. The other category where you've got staff who could effectively run the business without you does make it a little bit more difficult to get income protection. And that's where if your profits and ongoing profits of the business will come into the claims experience. So it is, if you're self-employed, there's almost no reason you shouldn't be seeing a financial advisor when it comes to income protection and your personal insurance needs, because it's super important to make sure, especially today, setting up the policies today, it is much worse a claims experience for income protection holders than what it used to be. Back in the day with agreed value, self-employed, who cares? You could still be earning your profits from the business. If you're not working, you can get your agreed value income protection. Today, that's not the case.
Interesting. So that's definitely important then to speak to an expert. And there are other things outside of the personal insurance regime, of course, like different types of business insurance that people can explore as well. All right. So people can get in contact with your team, just like I have, and book a call with one of your advisors by following the link in the episode description or show notes. And it actually supports Rask by doing that as well. So that's great. But there is a final action point which I want to get from you. Every episode, I'll ask you for one thing that people can take away, something that people can consider, just something they could do, whatever the case may be. In the first episode, you said just be aware of what you currently have in terms of your cover. Number two, for episode number 2, you said, how much do I need? Just be reasonable about what you might actually need for insurance cover for you and your family. Episode 3 was all about income protection, mate. That's this episode. What have you got for us?
I did mention it before, but I completely forgot what I mentioned. But I will come up with 3 other things quickly. So the policy that we didn't touch about, or some of the features, is the waiting period. So think about the waiting period. How long you need to wait before you start getting paid is really important. So if your policy is a 30-day waiting period, but you could actually reasonably wait 90 days, then maybe extend that waiting period, and that'll save you in premiums. It'll be like a 25% drop in your cost for that income protection. If it's a 90-day waiting period, but you can't survive more than 2 weeks without an income, well, consider bringing it down to a 30-day waiting period. So that's really important. Also, the benefit period. This is another really big one, is a lot of super funds will only cover you for 2 years maximum. So the benefit period, have a look at that. If it says age 65, that means that you'll get paid every single month until age 65 if you can never work again. Now, majority of people only ever claim for less than 2 years, but 80% of all the claims payments from insurance companies is for anyone post 2 years. So again, it's less likely to happen that you need it for that long. But if you ever need it, the financial impact is huge. It's kind of our discussion from the last episode about TPD. Very unlikely to happen, but if it does happen, financially stuffed. So the benefit period is really important. If you can't last more than 2 years with it, if you can't last, if your income stopped in 2 years' time, then extending that to age 65 may be really important. And then the third one to think about is, a lot of people look at the benefit amount, so that, how much I'm insured for, $7,000 per month. Go to paycalculator.com.au, I think it is. Put $7,000 in that pre-tax income on a monthly basis and have a look at what the post-tax payment will be. And so often some of our clients will come back to save money and go, oh, can I reduce that benefit from 7 to 3? At the end of the day, I don't pay your premiums. You can do whatever you want, but we try and give people the understanding of what the post-tax payment would look like. Because often people think, I can live off $7,000, but can you live off $5,200 or whatever that post-tax amount will be? And that's a very different story. So look at the waiting period, How long is your waiting period? Is it appropriate? Do you need to extend it or shorten it? How long's the benefit period? Most policies that you haven't actively set up will be 2 years. And then look at the post-tax benefit amount.
That was your point. I'm pretty sure that was your point.
I'm glad.
The post-tax amount. You said you would come back to that. So I'm pretty sure that's the one. So paycalculator.com.au to check what your after-tax amount would actually be, because that's the reality of what would hit your bank account. That's a really good point. So Phil, we're going to come back in the next episode and we're going to talk about the different ways to pay for all these types of insurance. The next couple of episodes will probably be a bit shorter for people, but probably the really punchy stuff and really important stuff will come. So we've got next episode is the different ways for people to pay for their insurances. Followed by that, we're going to talk about the application process and what you should expect when you go through this. There are some real important catches here, including one that I think I might have fallen into. And the sixth one is how to review and adjust your cover. And then finally, when to make a claim, how do you do it? What does that look like? So those are the episodes to come. Phil, I know you're doing some great work at Skye, so I really appreciate your time.
No worries. Thanks, man.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.